This is our inaugural function, private equity, the state of reps and warranties. So we'll wait a couple of minutes to let folks enter the meeting. I'd like to introduce our speakers briefly. We have Sean Sarsfeld, Director of Forensics and Valuation with BKD CPAs and Advisors. Ryan Renaud, Executive Vice President, Special Projects at Intoro. Jeff Henningsen, President, Lockton. Vince Morgan, Partner at Bracewell. And just a little bit about the FANG. Financial Executives Networking Group is a 501c3 founded in 1991 as a forum of senior financial executives to share deal flow, job opportunities, and experiences. Members have had titles such as CFO, Controller, Treasurer, Managing Director, and Vice President of Tax, M&A, and Internal Audit. We have approximately 36,000 members, with our members currently represent senior financial management of over 8,000 private and 2,500 public companies, with over 40% working at companies with sales over 500 million. Private equity, the state of reps and warranties. During this fireside conversation, the panelists will explore the current state of reps and warranties from the points of view of an investment bank, an insurance company, an accounting perspective, and from an attorney. Reps and warranties refer to statements of fact that a seller makes as part of trying to persuade a buyer to purchase their business. Each of the parties in the transaction relies on others to provide the information about the transaction. The seller provides assurance that the business is worth the investment that the buyer plans to make. The buyer must be provided with sufficient information to support the seller's asking price in the transaction. Some of this information includes financial statements, lists of current contracts, customer listings, and proof of asset ownership. During the negotiations of the purchase of the business, it is the role of the buyer to demand more information from the seller in regard to certain statements of fact made by the seller. This is because the buyer bears more risk than the seller, and therefore must make sure that all questions are forwarded to the seller for a response and that all information required for the transaction is provided. The buyer's legal team is also tasked with ascertaining that the deal is within the legal framework. If the buyer intends to use its stock as part of the consideration for the transaction, it must make a statement to the seller that the stock provided is free of any encumbrances and that the buyer is legally allowed to offer the stock. Private equity, the state of reps and warranties. Sean, if you could kindly introduce yourself, please.
Good morning. My name is Sean Sarsfield. I am a director in the Forensic and Valuation Services Group with BKD in Houston. For those of you that are not familiar with BKD, we are a top 15 accounting firm that offers traditional accounting services, audit and tax, in addition to investment banking, forensic accounting, and expert witness services. I have 20 years of forensic accounting experience, both on the front end of deals doing due diligence work, and then after the transaction to investigate allegations of fraud and to calculate damages and disputes.
Excellent, thank you. Jeff, can you kindly introduce yourself, please?
Fantastic, and thank you, Mark, for having myself and our panel here today, and excited to get to speak to FANG. Wasn't really familiar with the organization and have had a lot of nice reach outs from y'all on my LinkedIn, and I look forward to getting to know each of you today. For those that don't know Lockton, we're the largest privately held insurance broker in the world. Today, specifically on the rep and warranty side for Lockton, we'll do about 800 transactions this year where we place rep and warranty for our private equity and corporate clients. My background specifically, I've spent the last 30 years in the private equity space, 4 years with a private equity firm from 1990 to 94, and then the last 25 plus years working in the insurance space, serving the private equity community. Have a fairly large team that serves transactions from rep and warranty to diligence, employee benefits, and then post-close transactions all the way through exit.
Excellent, thank you. Ryan, can you kindly introduce yourself, please? Thank you.
Sure, I'm Ryan Renaud. I'm the Executive Vice President of Special Projects with Intoro. My background is somewhat as a generalist. I'm a CPA, lawyer, and a CFA charter holder. With Intoro, I work to negotiate several of our joint venture agreements, and then also help our clients when there is a particularly complex matter to work through with regard to an offering, or if we're providing investment banking.
Excellent.
Then,
No, go ahead, please.
so for those that don't know Entoro is a broker dealer investment bank, RA financial services group that is focused on creating an ecosystem for alt investments.
Excellent, thank you. And finally, last but not least, Vince, can you kindly introduce yourself, and also thank you, Bracewell, for hosting us at your fine offices.
Yes, thank you. Well, we're delighted to host this group and talk to the FANG. I'm Vince Morgan. I'm a partner at Bracewell. For those of you who may not be familiar with Bracewell, we are an international law firm, full service for our corporate clients, everything from transactions to regulatory to strategic communications and litigation, whatever their needs are from a legal standpoint. We're here to help them with that. I lead our insurance coverage practice, and unlike most large law firms, we only represent corporate policyholders, which means that our entire corporate client base, we help them with whatever their insurance and risk management needs are from a legal standpoint, whether that's helping them place coverage through brokers like Lockton, navigate the claims process, or if disputes arise, then we help them steam in there and deal with those two.
And then finally, your host, my name is Mark Hamza Abubakbo. I'm a corporate strategist and business development executive. And this is an example of, putting together a panel that will more than likely be doing business together if they are already not doing business. And so into our discussion. And folks, if you can kindly, whilst we're doing our discussion, put your information in the chat, share your LinkedIn profiles, share your company websites, and then also what value that you bring to the table, and then also what it is that you're seeking, so that we can have some networking during the conversation. People can reach out to each other, and then post meeting, after we finish, we can also have a brief discussion and introduce ourselves as well. So, okay, so let's get started. So Jeff, has the market continued to expand in usage of reps and warranties? This was a product that few in the M&A world had heard of in 2010.
Yeah, so I think just for a little history for those that aren't familiar with how this product has developed, it's been quite interesting. It was a concept that probably roughly 12 to 15 years ago came to the marketplace with and was received with a fairly big yawn. And really until firms like Sun Capital, which is a large private equity firm out of Florida, started using it as a differentiator in their bids to buy companies, basically telling a seller, hey, you're going to get to walk away, you're going to get to keep your escrow dollars, not have to wait for 18 months to 24 months to play out. We'll let you walk away from the transaction with your cash at close. It started to gain a little bit of traction. It didn't take long for the investment bankers to start to realize that this was an advantage for their sellers, and it started to become more popular for investment bankers to require reps and warranties for the buyers in their bids. And of course, not only did the sellers get their money quicker at closing, or all their money, but the bankers did too. So it was a win-win. And that's really when things started to take off. And so over the last 10 years, each year we've seen an increase in volume and interest and utilization of the product. And now I would say that 80–90% of the transactions that Lockton is involved in for corporates and private equity groups are using reps and warranties. The deals that are not being utilized are typically on the smaller side, under $50 million of purchase price.
Excellent. And from your point of view, same question.
Yeah, same thing here. I mean, our deal lawyers do M&A transactions of all shapes and sizes across every sort of manner of industry, and it has become sort of a standard aspect of an M&A transaction these days. They don't use them in every deal, but it's at least considered and in every deal, and it's used in the vast majority. I think. Jeff mentioned they will place 800 reps and warranties policies this year. Our deal lawyers, the transactions, it is also several hundred deals where We will be either advising a buyer on a transaction where they're getting one, or sometimes even on the sell side. We help both, whichever side of the transaction we're on. We're doing this, day in, day out.
So I'm going to add just to that the statistics for the U.S. that we're that we can find estimate that the rep and warranty transaction count is going to exceed 3,500 this year, and that's just in the U.S. Warranty and indemnity, which is what it's called outside of the U.S., is also quite brisk and used in transactions all over Europe, Australia, the Pacific Rim.
Excellent, super. And so Vince, as the lawyer in the group, tell us how you help your clients deal with these issues.
Well, yeah. So from our standpoint, we look for if we're helping a client that is in the middle of a transaction and they're trying to figure out, okay, look, I need a reps and warranties policy as part of this deal. And, we'll work with a broker, someone like Lockton, we work with them day in, day out. And that's a great, add to our team here, because they'll go out in the market and say, look, this is, what's available. And then we'll kind of focus in on one and then, really examine the wording, find out, is it, what we expect to see? Is there some new provision in here that we haven't seen before? And if there is, then that's where we approach it from a legal standpoint and think, how would a court construe this provision? Since it's, hasn't been tested. So we focus in on those things. We make sure that, the exclusions have standard exceptions to them and things like that. And then finally, we also look at things like choice of law and forum, because sometimes that can be outcome determinative if a claim arises or a dispute arises. We want to be, knowing what our clients are getting, and so we can advise them on that. So we look at it top to bottom, suggest some wording improvements, and then again work with say the folks over at Lockton, and they'll tell us look, these we can work on, these probably are non-starters, and these maybe it's going to impact the premium or whatever, and we just and we help our client work through that as part of their deal team.
Super. And then can you give us some examples?
Yeah. So one example is again forum and venue choice of law. So a lot of these policies choose law that isn't very favorable to policyholders. We'll look at that, and if it doesn't really bear any relationship to the transaction, then we might ask, can we use a different state's law, because insurance in the U.S. is regulated on a state level by and large. There's a couple of exceptions to that: flood insurance, crop insurance are two of them, terrorism is the third. But by and large, these are all state driven, and so we'll look at what state law is going to apply to a reps and warranties policy. We'll look at the venue, right? A lot of them have almost all of them have arbitration clauses. That's very common in these policies. We love arbitration generally in the right circumstances. We just don't think this is one of them, because what it does is it creates an asymmetrical information gap where carriers have access to much more information about how these claims are developing and how they're being, how they resonate with decision makers and arbitration tribunals and whatever. And that seems unfair to us, that they should have all this information and insureds should have none of it. And so we really do try to see if we can have some legal recourse here through the courts. And frankly, I think this is something that insurers are in their desire to have these be governed by arbitration. I think that's a mistake, because the insurance markets work better when language gets tested through courts, and that way it sort of has this honing effect where eventually it standardizes language that everybody can live with. And without that, it means that we're going through this process every time like it's new, and that frankly isn't in anyone's interest. So we try and we're fine with saying let's mediate as first, and then but if not, we'd like to have the ability to go to the courthouse, because again, we think that actually helps foster market forces here and develop this product in a way that's better for everybody.
Superb. And then so Ryan, what are some indirect considerations you think about when reviewing or negotiating reps and warranties?
So I think to add on to that, what I think about is what is going, how do these reps and warranties go beyond just the impact of the two parties, and what are the third parties that may see these reps or be impacted by the reps? So for example, when Entoro Securities broker dealer goes out to do an issuance, it's important to me that all the reps match up with any securities laws that we have, or in also in that issuing context, there are two contracts. If it's related with a deal, right? There's the buy sale, and then there's also the contract between Intoro Securities to raise capital for the deal. And so it's important that the reps and warranties in those two contracts line up, and also that they comply with or give us support for compliance with the securities regulations. The other place I've seen this somewhat come in is with investor communications. And so, for example, last week, Intoro offered one of the first NFTs as a security, and there's a buy sale agreement or subscription agreement associated with that NFT. And in that subscription agreement, there are also obviously reps and warranties. And one of the things that we went through at the last minute and just double, triple checked was, are all the reps and warranties in that subscription agreement consistent with all of the disclosures that were in the PPM? Because that would be something where if it's challenged later by an investor, you could have issues and litigation if those two things are different. And I've actually had one deal where there was an investor that came back and questioned several of the disclosures that were in the documents provided to them. And that issue was resolved relatively quickly and amicably because we were able to pull up the underlying contract and show the reps and warranties and the assertions in that contract matched all of the disclosures that were given to that investor. And that's not necessarily something as well that would be covered by rep and warranty insurance, and that's a liability for that can end up being a personal liability for investment bankers, for officers, for others if those disclosures are not accurate. So I think that's another consideration when you're dealing with reps and warranties. Is it consistent with all the other documents you publish to third parties?
Excellent, thank you. And Sean, as a CFE, Certified Fraud Examiner, have you ever gotten a call to investigate fraud in regards to reps and warranties relating to a transaction?
I have, Mark. And for those of you on the call who aren't familiar with the work that I do, usually I get called in post-acquisition, post-transaction to investigate allegations of fraud or other issues that may relate to the transaction. People like to throw around the F word. I think it's careful that you have it clearly defined. Usually it is defined in the agreement, something along the lines of an intentional misrepresentation of a material fact or the omission of a material fact that induces the buyer into the transaction. There's sometimes a difference of opinion, which in my mind isn't necessarily fraud. Say, for example, the seller has inventory that they have valued, using an egregious example. They have it valued at $7 million, and it's something that's been accounted for with generally accepted accounting principles. And then you have a buyer that comes in and says, post-transaction, the inventory here is only worth 2, some of it's obsolete, some of it can't be used, et cetera, et cetera. In my mind, that's not fraud. That's a different opinion. Maybe you have to drill down. I know people like to make allegations of fraud because there's typically a really easier clawback, so to speak. When I think of fraud in a transaction, it is inflating the assets, fictitious assets, inflating sales numbers, and things of that nature. So.
Interesting. And so what would you recommend for folks in regards to fraud prevention in regards to their transactions, Sean?
I would recommend that they don't skimp on the front end. I know a lot of firms look at due diligence in regards to fraud. Don't go cheap, so to speak. It's going to cost a lot more on the back end to clean up. One of the recommendations that I make with people is be involved with your due diligence team. In regards to the target, you probably have an idea of the industry that you're in and where the risks lie. So work with them on minimizing the risks involved. If you're doing an international business, you're going to want to look at anti-corruption related risks. Some of the other issues that I've seen from a due diligence perspective are the procedures that are involved in the due diligence. Being a forensic accountant and coming in and cleaning up afterwards, a lot of times the procedures that they have are very rigid in terms of putting together these are the specific items that we're going to look at. Whereas when I come in as a forensic accountant after the fact, a lot of times I will have very broad, I'm going to look here, I'm going to look here, I'm going to look here. But at the same time, I'm also going to take a look around. You know, it's not unusual for me to just hop on a engagement, look at the general ledger just to see what I can see. In other words, if I'm a detective and I'm investigating a murder that happened in a specific department, if I see a trail of blood going down the hallway, I'm going to go investigate that. I'm not just going to stick with the procedures that have been agreed to by counsel in regards to due diligence.
Mark, I had a question that maybe Vince or Sean can chime in on, but the pre-rep and warranty insurance, the lawyers, I remember, would spend countless hours and late into the morning negotiating whether a T was crossed properly or sentence was written properly. And there was always a theory or concern that as rep and warranty became more popular, the lawyers wouldn't negotiate as hard. Maybe they would scrimp on diligence. Have you seen that play out in the claims that you're dealing with where maybe documents haven't been negotiated as far as they would have been without rep and warranty insurance?
I haven't. I mean, I do think that reps and warranties insurance provides a nice bridge of what used to be a pretty intractable problem, right, between buyers and sellers, and because sellers just want to cash out and move on to whatever else they want to do. Buyers, need some, assurance that the reps and warranties are, accurate, and reps and warranties insurance is a lovely bridge between those two worlds, right? That makes it easier for everybody. But I haven't seen the transactions certainly that we do, and then again, because we're one of the very few large law firms that doesn't have carrier side conflicts, we actually get asked to do reps and warranties claims that other law firms did the deals on. And because they've got conflicts and can't do it. And even when those come to us, I review other law firms, purchase and sale agreements, and they look like they were lawyered just as well as they were before. This is sort of something that makes these deals easier to get done.
What about from any fraud perspective? Have you seen anything where?
I'm not seeing any changes. I don't know if I want to get into it now, but talking about recovering from insurance companies, haven't worked with Lockton before, but generally the response you see from the insurance companies, I feel like it's, it just depends what you get. Every company's different. Every adjuster that you work with is different. So in regards to the timeliness, the responsiveness, trying to get a payout, it's difficult. You don't really know what you're going to get going in. So just be aware of that, which is always why I recommend that people do the work on the front end so you don't have to deal with it.
This, more than lots of other instances, is where an ounce of prevention is worth a pound of cure. I mean, that statement is true in so many aspects of life that this is certainly, it bears down here.
Right?
Yeah, so I think I'll just jump in. One of the points that I was thinking about is to me, when you're working with reps and warranties, there's always partially a conflict between do I make something brutally truthful and objectively verifiable, which I think is probably better for the insurance company, or do I make it a little more vague and loose? And Vince, what your view is on that, but to me, there's always this push and pull between, do I try to make it more open-ended, or do I just make it objectively verifiable?
Yeah, I think there is that tension of how best to come up with a commercially viable, set of wordings that A, the parties to the transaction will take, and that B, an insurance company or syndicates will underwrite, right? I mean, they need to be comfortable with the deal wording too, because ultimately they're backing it. And that's where I think, Jeff, your team comes in, and they may comment on. They'll want to look at the due diligence for the deal, right? They'll want to have access to the data room. They'll want to look at the transactional documents. They'll have some questions. They'll say, hey, did y'all look into this? And hey, what about that? And they'll have, sort of their list of questions. They've got deal folks too, who will, are used to doing these kinds of transactions. They'll have their inputs, but they may come back and have wording suggestions. Jeff, are you seeing a lot of that, or a little, or somewhere in between?
Just, I'd say a little bit of it.
Yeah.
Yeah.
Super. Okay, so Sean, you tend to get involved in post-acquisition disputes that sometimes end up in court. What's the number one issue you see in regards to deals that you want to make the audience aware of? And Vince, you know, if you can chime in on that as well.
Yeah.
I think we've already said it, do the work on the front end so you don't have to do it on the back end. One pitch would be, or bit of advice would be, to get insurance in regards to the deal. For the litigation matters that I have been involved with, I mean, litigation is time consuming, it's costly, it's draining on you, it takes a lot of time. I've been kind of involved in the nightmare scenarios where, it's a transaction in the hundred millions of dollars. So the parties involved are all the big players you would expect, but there's still fraud because somebody didn't dot the I and cross the T's. In that transaction, there's one I'm thinking of the top of my head, there was no insurance. So we had to come in, investigate the fraud. We found it. It was absolutely blatant in the tens of millions of dollars. But then we had to turn around and commence litigation against the sellers to freeze their assets. Now, I don't know how big of a problem that is in the US in terms of chasing that. I would imagine I'll let Vince speak to that. I don't think it would be that hard. But if you're doing an international deal in another country, I'm looking at you, China, trying to recover those assets when the money's gone out the door is extremely difficult.
Yeah, that is tough. So I share that view. I mean, other than the part about litigation being expensive and costly and draining, I mean, that I don't know about.
It's really cheap. Probably worth the expense.
Yeah, right. But on the post transaction angle, a couple of thoughts on that. Number one, all of these deals have a post-closing adjustment process, right? So if you're buying, say, some company, and you expect between the time that they strike a deal and they do the paperwork, and then whatever time needs to elapse before closing happens, right? They say, we think on closing date you will have X dollars in cash and Y dollars in inventory and Z dollars in debt, right? We make estimates on working capital and things like that. And then at the at the closing date, you calculate all those things, and they're never exactly what the parties expect, right? There's some variances, some are up, some are down. And so the parties have a process, so they go back and they work through those issues, right? And all reps and warranties policies have an exclusion for amounts that are recovered in a post-closing adjustment process that are the same dollars that are being claimed in the insurance claim, right? In other words, what the insurance company says is, you have $10 in losses, and $2 of them you got back from the seller, right? We only want to pay you the 8, right? And that seems, sensible and fair. The problem is it gets harder in practice to figure out some of these things. And so what we suggest to clients is that they really think through the post-closing adjustment process. And if at that point they're thinking they might have an insurance claim, then they need to give some thought to, how all that stuff fits together to make sure that that they're getting what they need to get on that adjustment process, and also thinking about their claim, so ultimately they're left whole, no better, no worse. And but again, it gets harder in practice, and I think from the carrier standpoint, if that adjustment has several entries and it's not allocated, it's impossible for them to prove how much was attributable to a particular thing. And that's really that's another thing you've got to think about as you're working through these transactions.
Super, thank you. And folks, if you have questions for our panelists, you have 4 experts here, kindly put them in the chat, and I will field the questions to our panelists. And here's a question from the audience, from Sonal Patney. So question, what are the consequences if reps and warranties are not met? And I'll go to you, Vince.
Yeah, so a couple things. I mean, if a rep and warranty in a transaction isn't honored, right, then that's a breach. It may subject the party that made that rep and warranty to liability for breach of contract or other claims. But a lot of transactions these days have materiality scrapes and non-survivability clauses that essentially say that absent a very few fundamental representations, they all don't survive closing, at which point then your recourse is not to the seller, but to the insurance company that agreed to step into place and honor those reps and warranties. And so, it gives rise to a claim under reps and warranties policy, and the claims that we've been handling, the carriers are pretty good at recognizing when a breach has occurred and acknowledging that. And, it gets a little trickier the rest of the claim forward, but generally speaking, we've not seen a lot of disputes on that from the carriers. Jeff, I don't know if your experience at Lockton is different, but that's what we're seeing.
Yeah, and just to chime into that, I think for the last probably 15 minutes, we've been talking about claims, so it might be helpful for the audience to hear. Just from the Lockton book of business, we're seeing notices of claims on about 20% of the policies that we place. So you can do the math on 800 transactions, what 20% is. Most of those claims are for amounts that are falling within the deductible or the retention on the policy. But 3 to 5% of the policies that we place, the underwriters are actually paying, and some of those are fairly material amounts. Vince can probably talk about the types of claims that we're seeing, because that's not my particular area, but it's they are getting paid. But I think Vince may have mentioned this earlier. If you're familiar with property insurance, which a lot of folks are, and how difficult it is to collect on a business interruption claim, that's really how you have to go into making a claim on a rep and warranty. Very similarly, you're not just going to be able to notice an underwriter and say, hey, I was wrong, or this is the claim, and write me a check. You're going to have to hire experts to prove out your claim, just like you would if you were suing the seller for calling back on the escrow. So a lot of people, I think, when they were first buying these policies, felt like it was just send the underwriter a request and the check's going to be written quickly. And maybe you can expand on that, but it's not that easy.
Yeah, that's exactly right. It isn't just an email that says this rep was breached, and we'd like you to write us a check for the policy limits. That's just not how this process works. And the insurance companies have been doing this for hundreds of years. They have it down to a science. And what they do is they have adjusters, they have forensic accountants, they have lawyers, they have experienced insurance professionals, and we tell our clients when again, all we do is represent corporate policyholders. We tell them they need that same team, right? So one of the first questions if the client calls us out of the blue and says, "Hey, we've got your name from some accountant or some lawyer or some other client or whatever," and it doesn't say we got your name from our broker. Our first question is, who is your broker, right? And we find out, because the larger brokers, they do more than just sell policies, right? They are your advocates too. And so, we find out that Lockton is involved, for example, they've got a great claim advocacy group. And so we want to get them part of the team to help get this claim going in the right direction. You need accounting support, people like Sean, not just any accountant, right? You need somebody who is experienced in these kinds of claims and who can quantify it in a way that the insurance company can understand it. You need legal counsel, not just any lawyer. You need specialized coverage counsel and hopefully coverage counsel without any conflict issues, so that you can feel confident they're going to do their best job for you. So you need to have the same kind of team, and every now and then you need technical experts too. I mean, we had one a while back that was a rep warranty involving a factory, and one question the carriers raised was whether or not, technically speaking, either the issue was known about before the policy accepted, before the transaction closed, and or whether or not technically from a technical perspective the rep was actually breached. That required scientific expertise that we had to go out and find. And so you want the same team that the insurance company has, so that these people can communicate with each other and keep talking and making progress. You don't want things to just break down because people don't know how to communicate with each other. And then hopefully that works. If not, then you've done everything you can to set it up well for litigation if you're unable to settle it, and that's important too.
I think what you've been talking about is after the transaction. I think if there's a you do the PSA, you put the deposit down, and there's a diligence period, then you're going to go to the closing table. Right. And if you discover a rep warranty is not true in the interim,
yep,
then you don't have to close.
You don't. Right.
So on the investment banking side, we're always pushing to keep the momentum going to get to the closing table, and this can be something that just stops the deal dead in its tracks until it's resolved.
That's right, and hopefully it's something that can be resolved, right? But sometimes they're just deal killers, and it is admirable. You see clients with the discipline to say, look, this is what we were supposed to get. We didn't get it here, and they'll walk away unless whatever the issue is gets addressed in a fair-minded, meaningful way. And so yeah, this is a constant stage of gates, and you have to pass through every one.
Sure.
And I wanted to go back to the point that Vince made, and just make you aware. A lot of times, insurance companies, and again, not Lockton, will try to bring in their own lawyer, bring in their own forensic accountant. Just remember that they are going to have a little bias associated with them. I mean, they're obviously not going to keep hiring the same forensic accountant over and over and over unless they're happy with their opinion, which is probably that they're not paying out much. At the same time, take a look at your policy. The most important part is your professional fees are probably going to be covered by your policy. So the fees that you paid for me, the fees that you paid for Vince may be in part covered by your insurance policy.
But I want to maybe put some brackets around why everybody keeps saying not locked.
I've been waiting on that.
Yeah, exactly. So may not have been clear in the intro, but Lockton is an insurance broker which represents clients in placing coverage, negotiating coverage, and helping with claims with underwriters. So when they're saying not Lockton, it's because we're a broker. The underwriters are the AIGs, the Chubbs, et cetera, that are actually placing the coverage, taking the risk, and responding when a claim is made to either reimburse for that wrongful act or not.
And I'm glad you took the time to clarify that, Jeff, because it is surprising. I mean, all I do is insurance law every day. That's it. That's all I do. And so, I work with insurance professionals across the spectrum. But it is surprising to me just how easy that fact right there gets obscured. And sometimes clients don't fully understand it. Sometimes lawyers don't fully understand it. Sometimes, Sean knows it too, because he's in this, he's in the thick of this every single day as well. But that is a key fact that sometimes gets obscured here. And it's important to keep that straight. You need to know who's on your team, and who's the other team.
Excellent, super. And folks, please continue to share your questions. These gentlemen are extremely busy. It was actually an act of God getting them in the same room together today. So we have a question from Rob Shaw. What are the most common breaches of reps and warranties?
Yeah, I think on that, accounting issues is sort of number one, right? That the books and records fairly and accurately represent the financial performance and condition of the company, right? That tends to be a really big one. Sometimes, we had one where the rep was that a certain asset would perform the day after closing, just as it did the day before closing. And we found out that the asset was in an unsafe state. It performed exactly the same way before and after, but it wasn't safe either day. And so it wasn't fit for the purpose that it was designed for, and that was another rep and warranty. So, but usually it's accounting driven, and it doesn't mean that the books are crooked. They just might not be quite straight. And you've got to look at that. And then once you find out that there is an accounting issue, then, and again, you go to guys like Sean, who will say, okay, we know that they weren't right on this day. Let's look back in time and figure out how long ago they weren't right. And you've got to figure that out so you get your arms around the problem and figure out how to approach it.
I don't know if I'm necessarily gonna call this a breach, but I think the number one issue that I deal with post-acquisition is earn-out, which makes sense to me. The money that you're paying, you want it tied to the future financial performance of the target that you're acquiring. Anecdotally, when I'm at the airport bar, when I'm at the hotel bar, and I tell people what I do, it never fails. I get a seller who just says, I got hosed on my earn-out. And the best I can do is give them my business card and say, I'll be more than happy to take a look at it for you.
You could buy them a drink too.
Yeah,
I mean, that's another thought.
I'll keep that one.
Yeah,
Sure. I would highly recommend that you work with your accountant, talk to Vince on the mechanics behind what the earn-out represents and how it's calculated. Because if I am the CFO or controller of the acquired company, and I have a fiduciary duty to the company, and it may not be within the spirit of the purchase agreement, but if I'm going to pay out certain funds to the previous owner that are just going to leave the company and don't really have much value to me, I am possibly going to go look for that loophole. If I have a chance to take that money and instead, pre-purchase assets, upgrade machinery, equipment, acquire a new warehouse, whatever it may be, I'm going to see if I can take that loophole as opposed to paying out here.
Jeff?
No, I was just, there was a question a couple up that was asking about the survivability of reps and what we're seeing now. And I would say, interestingly, this has evolved over time. The policies, and I actually phoned a friend while we were talking, so texted a friend on our team. But the policies are typically 3 years for general reps, 6 years for fundamental reps. But the common policy that we're seeing right now is really more of a public style, 100% walk away type structure for the seller. So the buyer is relying on the insurance policy to step into the shoes of that rep and warranty obligation of the seller. And so that's actually made closings move faster. It's allowed the seller to walk away, and it's allowed the buyer, when there is a claim, which is interesting. Historically, when there's a shared deductible, meaning the seller and buyer would maybe share 50% of the first, let's just say $1 million of potential claim, that would mean as a buyer, I would have to sue the seller first, satisfy that $1 million deductible by getting $500,000 from them, and then I'd have to go sue the underwriter. By having these walk-away style public type structures, you're just going straight to the underwriter with your first claim, as opposed to having to fight twice in that transaction. So I don't know if you're seeing that in your world or not.
Yeah, that is, they are pretty much the standard is total walkaways these days. And again, that's why reps and warranties is a pretty elegant solution, because you can step in, sometimes you buy a company, you take the Berkshire Hathaway model, they just want to own it, but they love the management team. They don't buy companies that don't like the management team, right? And so they say, look, I just want to own your company, but I want you guys to run it. And if you now have a lawsuit against the people who are now your employees and your management team, right, that's just a terrible spot to be in. And so, either because the sellers just want to take their proceeds and go, or because there's an ongoing relationship between the new ownership and the seller team, either way, you don't want to be in that situation. And so, the insurance policy is usually the last and only means of recourse here. And that's why it's so frustrating. And Jeff, I know you're seeing this when you talk to a client that has a claim, especially if the carriers don't step up, right? They're like, look, I bought this company based on, these representations and these warranties, and it turned out they weren't true. Right. And I'm not saying that, we were lied to, but they weren't true. They weren't accurate. And then I file my claim, and then the insurance, so I've already got one breach, and then the insurance company, if they don't pay, right, then they've suffered a second breach. And that's just, it makes clients very frustrated when carriers don't step up and pay these claims, because they feel like they got violated again. And that's a really hard thing for clients to stomach. And I think that insurance companies need to be, thinking about sort of the client's frame of mind when they go about adjusting these claims.
Well, that kind of leads to, you mentioned Berkshire and loving the management team, and it led to another thing that I think is important for the audience to know, is that a lot of transactions have seller rollover, where the management team or the sellers are wanting to participate in the new entity, go forward, and maybe get a second bite at the apple. You need to just be really conscious of what that threshold of rollover is. And when you get to 25% or greater, it gets more challenging for underwriters to want to extend full rep and warranty coverage, when the selling parties who are effectively making the reps are potentially going to participate in the reimbursement of a breach of a rep. So it creates a really difficult situation to handle.
Right.
I haven't had too many issues with breaches. I'm trying to think.
Lucky.
Yeah. So I think I have two comments. One, I don't think we've ever, I think when there are issues, it's not, does the entity exist? Those things that they're easy to verify. To me, the place that we spend in negotiation are always the deal specific provisions, which I think are the harder ones to get right and the easier ones to have a breach if you don't have that wording right. I think my other kind of trap that I have unfortunately wandered into once on the reps and warranties and breaches is I think it's very important to be cognizant that you need to break up the reps and warranties with any future covenants, right? So, I'm thinking about a particular joint venture where there was an investment, but there was also a services agreement, between one of the joint venture partners and the joint venture itself. And, that said, we have X number of employees and capacity to do this, and we will have it at close and for, a certain period after. Well, having it at close is a rep and warranty, you would have it closed, but by adding that and for the certain period after, you're creating a future promise or covenant. And mixing those two things together just creates problems with the contract, enforcing the contract. And that one didn't have reps and warranties insurance on it, but Jeff, I assume that creates a headache for you because it's not something that was there at close. It's this promise that has somehow gotten mixed in.
Yeah, I think, again, going back to how these things get played out in a claim, it really is incumbent on the claim to prove that case. And you're in that scenario, you're gonna have to really dig in and frame it out and get some third parties to help with that.
And your insurance is not going to cover a breach of a future covenant, right?
Right.
So that's something where maybe I thought I had insurance.
Right.
And so this is another question from the audience. Jeff Daniels, thank you. Since reps and warranties don't expire, do rep and warranty provisions cause a PSA to survive subsequent to closing? Same question for indemnity provisions. Thank you, Jeff. And I'll go to Jeff.
Well, I was going to say, you want to take that?
There you go.
I think this is, a little bit like what I was saying earlier. I think that's the one that caught my attention about the public style sale. I don't know if you want to expand on that.
Yeah, I think, it depends on what reps and warranties you're talking about. Again, there are things like, the company exists, right? And it's licensed to do business and, things like that, right? And of course, that's easy. But things about, the financial performance and condition of the company. I mean, a lot of sellers want to say, look, I will warrant and I will represent and warranty you that, this company, that our books are prepared in accordance with GAAP, and that they fairly and accurately represent the financial condition and performance of the company up through the closing date. But after that, I can't control what happens with the company. So I can't make you that assurance. And so most of them today just have a no survivability clause that says, it's the date of closing, other than a few select ones, like we haven't intentionally misled you, things like that. Those they're on the hook for, but otherwise they generally are saying we are done, and partly because they don't want to, but partly because they have a legitimate reason to say, look, we can't tell you how the company is going to run, when we aren't running it anymore, and that's a fair, issue, right? So I think it depends on what rep and warranty you're talking about. Some of them have a longer life cycle than others, but it tends to be these days just they're done at closing and that's it. And that's one thing that carriers always look at is, is there a potential subrogation action against a seller, right? They want to know that as they factor in their premium and their underwriting process. And if there's a claim, they look at that again to find out, look, if I have to pay the buyer, can I go get some of the money back from the seller? And so they're focused on those things as well. But just from a market standpoint, if you're selling a company and there are 10 potential buyers out there, and one of them says, I want you to warrant these things forever, and the other 9 say no, well, you're going to sell it to one of the other 9. I mean, it's just the reality of a very competitive business environment for M&A deals these days.
Super, excellent, thank you. And so, Ryan, why are reps and warranties not important?
I think we've covered some of that, and I think the comment on the trap that I've wandered into is one of those reasons that you know, you can have what you want to have on paper, but the reps and warranties are true in the moment at closing, and then after that, what happens, right? So with the example with the services agreement, you know, it was true in the moment. They had X number of employees that were available to provide the service, and you know, 30 days later, 90% of those employees were gone, and there's just nothing a rep and warranty can do about what happens after that moment in time when they're true. And so I think, you know, Vince made a comment to that as well, right? Your guaranteed financial performance have been X up to that date, and then afterwards you're on your own. And I think there have been multiple comments and this discussion that you know, the reps and warranties don't salvage a deal that is bad, right? If there's a rep that is crucial to the deal and it turns out to be untrue, and business loses money afterwards, you're left in a situation where you're dealing with the consequences of that broken rep or that false rep, and trying to salvage a bad business deal at the same time, spending money and resources on pursuing litigation or claim on the insurance. And reps and warranties are, legal recourse is always the last recourse because it's the most difficult, most complicated, and it pays you back for the harm, but it doesn't fix a bad deal.
Thank you. And so Jeff, what's the current state of the market? We've heard that pricing has gone up and carry capacity has gone down. Can you expound a little bit on that for us?
Sure. Well, with 3,500 plus deals in the marketplace, all of you probably in your firms, or at least if you have a small firm, are still feeling it in the marketplace, whether it's restaurants or insurance underwriters or brokers. Everybody's suffering from lack of staff, lack of capacity, and overwhelming flow of inbound opportunities. And so the underwriters are in the same boat. As an underwriter, many of them have restrictions on the amount of capital they can put at risk in a certain time period, year, et cetera, policy period. And so you're seeing underwriters effectively saying, we're not going to write this type of business, this size deal, et cetera. And as we get closer to the end of the year, it's going to get more and more difficult to get policies, particularly for smaller transactions or transactions that have some sort of nuance or hair on them. I will say that healthcare is traditionally always been difficult, but particularly difficult right now, just because of the volume of transactions. If there's any sort of payor risk in the healthcare space, that's going to be very highly scrutinized and probably excluded from coverage. So there's just it's a very difficult marketplace. We're advising our clients to get into the market very quickly if they have a deal that's going to close in this fourth quarter. And a lot of that also is because there's just a lot of very large deals happening. We're seeing deals that ranging from $500-600 million to, we have one deal that's an $8 billion transaction that is utilizing rep and warranty as insurance as a product on that transaction. That was unheard of 3 or 4 years ago. In fact, I think, and I didn't have to go back to my notes, but probably 5 years ago, you couldn't even put $100 million of limit together. And now putting together $1 billion of limit is something that is available in the marketplace, obviously with enough time to put it together.
Yeah, I think that's been an interesting thing, as a lawyer who helps, clients, we don't sell policies, that's what Lockton does. But we help our clients, look at it from a legal standpoint. How would this provision be construed, by a court, or what about, how does this compare to the transaction documents? And I mean, those are legal issues, and so there is a legal part of placing a policy, and we help our clients do that. But a couple of years ago, maybe longer than that, maybe 4 or 5 years ago, we would say that reps and warranties had a sweet spot of somewhere between 50 to 250 million, right? Those were the deals that, had enough money at stake to make it worth doing, but not so much money that it wiped out capacity, right? And now those numbers have gone in both directions, right? And and that's really great because this is a nice product, but so it's been nice to see that, but it's still something that, you've got to put your best foot forward here and look at these things every step of the way.
Gentlemen? Mario? No thoughts? Superb. So our claims are getting paid, Jeff.
Well, claims are getting paid. We talked a little bit about this earlier. I think, 3 to 5% of our policies are paying out on claims. Roughly 20% are getting noticed. So claims are getting paid, and I think we've kind of beat this dead horse, but you have to prove the claim. And it's not going to be an easy, scenario, unless it's a limits loss that's very obvious. We shared some discussion back and forth before the panel started, but the thing that you have to go into these claim scenarios with is the right team. I've seen scenarios where, in particular, one of my clients used their transaction team, lawyers, to try to start the rep and warranty claim process. These are lawyers that are really good at doing transactions, not good at proving out claims. They didn't call the broker, which in that case was us. They didn't engage with that law firm's specialist like Vince. And so they spent 1.5 years of legal fees pounding the table trying to get a claim paid when they didn't have the playbook put together to go to the underwriter properly. And so it got really far off the track. So the first call you should make is to your law firm to find out if they have a specialist that deals with rep and warranty claims, not placement, but the actual claims, and then also to notice the broker and get the broker to help put the playbook together that you can follow.
I have a question on claims. We can talk about this at a time, so I push a little bit on the spot. But is there a difference between a claim for fraud versus a breach? And my general understanding is fraud damages are limited to what you lost, and breach of contract damages can be benefit of the bargain. So how does that factor into your thoughts on the claim?
I'm glad you actually asked that because it touches into another aspect of these transactions. And you're right, the remedy for fraud and contract are different remedies. They're different claims with different remedies, but they all center on what the loss is, but the way they go about it is different. But the other part of this thing that we haven't talked about yet, which I'll use your question as an opportunity to do it. Thank you for that. Is if you're a private equity fund or just any buyer, right? You say you're buying a new subsidiary for your business, you want to add some capability you don't have, and rather than build it organically, you find somebody who does it, and they want to sell, and so you make a deal, and it helps you grow your business. So if you're that buyer, and again, whether this is purely an investment play or whether you're actually trying to help grow your business. And you say, all right, I will pay you $500 million for this company, right? And that is say that they're say that they have $40 million a year in annual revenue, and you say, I'll pay you 12.5. I'll pay you a 12.5 multiple on this deal, right? And so you get to a $500 million sales price. Now, like most lawyers, I'm allergic to math, but I think I did the math right on that. I don't know. I'll let you guys, Sean, you can tell me if my math is it close?
You're in the ballpark.
Okay. For a lawyer, I'll take that. If an accountant says I'm in the ballpark, good enough. So you look at that and they say, look, I paid a 12.5x multiple for this company. And part of my loss is the amount, the value of the reps and warranty that was breached, right? Is say that's $2 million. You say, well, it's 12.5 times $2 million, right? Well, there's another part of this. If you're a PE fund, or again, just a company trying to expand through acquisition, you would say, well, look, I paid 12.5x, which is a pretty high multiple, based on the idea that this was a high-performing company, right? They were crushing their earnings. They were very profitable. They were growing like crazy. And so I put a high-end multiple on this business. And it turns out that those numbers weren't right. And if I had known the true numbers, then I would have paid a lot less for it, because the accounting was riskier. because the growth profile was lower, because it costs more to run this business than I thought, because my internal rate of return, PE funds are always focused on hurdle rates and things like that, is I would have given it a lower valuation so that I could have made that same level of return. And so you end up with this idea of it's the multiple times whatever the rep is worth, plus I overpaid the multiple itself. And so you look at, taking that down, then that's another element of damages. And I think that's not something that's been explored enough in these things. But if you're a buyer, you need to really look, and this is where, again, folks like, Sean can come in and say, well, let's look at this, and maybe you get a valuation specialist to try and figure out exactly what the loss is here. It may be more than just the value of the rep that was breached times the multiple. It may be the multiple itself. And so you might have sort of a double pronged damages.
Yeah, there's a couple things I want to add there. Hopefully I can pull it all together. One, in regards to insurance companies, from my experience, they are paying out the claims. The speed with which they pay out the claims varies. I would recommend that instead of, as soon as the claim happens, they're going to start asking for information. Be careful in the information that you're divvying out. Don't just start throwing things at them. I would say work with your internal team, work with your attorney, work with your forensic accountant. I would suggest that you prepare a claim and have it done, and then move forward with that claim and present it to the insurance company so you have an idea of what your claim amount is and what you think it's about. That will greatly move the process along.
Excellent, superb. And then Sean, you mentioned to me previously that you utilize third-party research when you get involved with post-acquisition disputes. How would you tie that into reps and warranties in regards to a contemplated transaction?
Yeah, and a lot of this is, and the CPAs on the call will understand this. Due diligence tends to be like an audit task list where you're just looking at specific line items, looking at specific numbers, and sort of drilling into them and just, auditing a set of papers. I think it is very useful when you actually do this in post-transaction litigation is, what are the benchmarks out there? So we had a dispute that involved a manufacturer of automotive components. And one element that was being disputed were the anticipated sales of this company. It was wonderful because the projections were very detailed. You could see what automotive components were going into what vehicle. And fortunately for us, there are a number of third-party resources out there, JD Power boards, that actually do projections of sales by vehicle. I think it even goes down to trim level. So we were able to do a apples to apples comparison of, okay, here are the anticipated projections that this company is making for their automotive components. We can see what vehicles that those components flow into. We can see this third party, benchmarks as to what the expected automotive sales are going to be. And we discovered that their projections were incredibly way off. And it really helped us in regards to resolving the issues in terms of damages.
Thank you. And so, Jeff, is rep and warranty coverage the only solution available in the M&A market?
Sure. Well, so it's a pretty broad question, but I think where you might be going is in transactions, there are other things that might be a sticking point, whether it's an environmental issue that the selling entity's dealing with, or maybe the buyer discovered through diligence. Could be a tax liability where there's a tax opinion on a certain potential tax issue. We've even seen scenarios where there's been some fresh or existing litigation that's in some form of process, but it's not completed. So there's some uncertainty to how that'll play out. All three of those areas obviously are subject to the particulars of that scenario, have insurance solutions, and we've seen those utilized to help a transaction close. So one early scenario that I saw in my career, we had a client buying a $100 million revenue company. There happened to be a $1 million revenue division in a small town in Texas that was dumping fluids through a garden hose into a ditch running into a lake. I got a call from the client. They said, hey, dead deal. We got this environmental thing that it's freaking us out. We're not going to close. we were able to wrap an environmental insurance policy around it that would respond in the event that this became a real issue. And it put enough certainty around that they were able to close the deal. Same thing would apply to a tax issue. We've had litigation where a seller apparently had sat in a bar and on a napkin said to a coworker, if I ever sell this business, you're going to get X. The napkin didn't exist anymore, but the memory of the discussion existed. This popped up in the middle of a transaction, and we were able to pay an underwriter $1.5 million for that potential risk. And if it didn't play out, the underwriter actually was giving back a certain portion. So there's a lot of creative strategies out there. And I think at the end of the day, the message would be, if you have something that's impeding a transaction, don't just close the books. Give your broker or one of us at Lockton a call and just say, hey, have you ever seen a way to deal with this transaction?
Superb, thank you. And then this will probably be my last question. And then for you audience members, I implore you to connect with one another. And then if you have any kind of deal flow questions, if you're seeking to work with any of these individuals, just put it in the chat, or if you want to speak up, go ahead and do so. Ryan, what non-legal functions do reps and warranties play in deal making?
Yeah, I think we've talked around this a lot, maybe not explicitly said it, but negotiating the reps and warranties is part of this bigger negotiation process. And there are normal things that go into the reps and warranties that are probably not, very controversial. You don't pay a lot of attention to. But when you start negotiating the reps and warranties that are specific to a deal, what it really forces the parties to do is think about what is important here. What do we have to agree on to make the deal work? And so, it's one thing to just sit around the table with buyer and seller and try to get to a deal, but this creates a framework that you have to work through and forces you to identify those issues that are important that you need agreement on. And so I think, just as part of that process, it's important. And one of the reasons I noted this as a talking point is, talking with a more seasoned deal maker, this was the first thing that he said, was that it creates this process where you can reach an agreement. And that, when deals have problems related to something in the agreement, there could be legal recourse or insurance. And, it can be an even bigger problem if there's some item that is not talked about or that your agreement is silent on. So I think, as part of the non-legal process, this just forces everybody to think about what's important, get it to the table, and agree with it.
Can I just add in one quick, it doesn't really dovetail with that, but it probably is important for the group, if I can just add one.
Oh, no, yeah, we have plenty of time.
Thank you. So, and this kind of goes back to some of the things we've talked about today, but I just want to make sure that everybody sort of understands this. I mean, if you have a reps and warranties policy and it looks like there's a breach, and you call your broker, you say, we need to notice up the claim, broker says fine, you go through the policy, it'll tell you what you need to do, right? It's not a mystery, right? The policy will say, in the case of a claim, do these things, right? And it's sort of the standard reporter questions of who, what, when, where, why, and how, right? And then tell you, do you need to email it? Do you need to log into a web portal? Can the broker do it for you? Usually we, kind of go through some or one or more of those different approaches. But we've talked over here about getting a team together, right, with the right folks, the right expertise, so that our clients can match up with the insurance companies on a claim. But that doesn't mean, and this is really important, having, me here as a coverage lawyer helping a corporate policyholder doesn't mean that on day one, I start sending out nasty letters or filing lawsuits, right? I mean, we stay in the background as long as the claim is productively progressing. The last thing that we want to do is be out there as lawyers that kind of it inhibits further progress, right? So we kind of, we'll get in there and we'll help clients sort of look at these issues on the front end. Okay, let's think about this and think about that. All right, yeah, you all go move forward with the claim. You get the accounting done. You get the broker, claim group in there, and it's working. And you do this as a process, but it doesn't start with, let's go file a lawsuit. Let's demand arbitration. Let's send nasty letters. that's a last resort after none of, only after these things haven't worked out. So I want to encourage, if you're out there and you're thinking you might have tuned into this because you had a meeting get canceled, you were bored today. You might have tuned into it because you have one of these issues, and I don't know. But if you do find that you have one of these issues, look, we're talking about having the team ready, but that doesn't mean that we're all going to be playing, at the same time. And it's working together, but in a coordinated fashion. So I think that probably was worth stressing in case people were wondering, kind of how that process works. Thank you.
Yeah. If you had a meeting canceled and you were bored today and you chose to listen to a rep and warranty,
Got it.
that's one step above Saturday golf, which always creates a great map. And I do want to say a shout out. There's a couple people I've seen. Mark's been kind of scrolling through the photos. Jeff Sands, one of my podcast guests, I haven't talked to him in probably a year and a half when the pandemic started, and TJ and Mark from C-Suite. I'm going to be with one of your partners next week in Las Vegas. So it's great to see some folks I hadn't seen in a long time.
Excellent. And then, gentlemen, if you can kindly, each of you just summarize high-level points that folks want to, take away with each other. And then also part two is, if you can just kind of quickly mention obviously your work with private equity funds, just a little bit about what you do in the private equity space. And you may want to mention a couple of the folks that you work with as well. So Jeff, if you want to quickly summarize for me.
Sure. For those that weren't at the beginning, I guess where in my career and we serve everything from large buyout shops that do global deals to lenders. And so it's interesting because I get a nice purview into transaction volumes, not only with firms like Goldman Sachs and BMO Harris Bank, MidCap, we're their outsourced insurance department doing pre-loan insurance diligence. We're helping them with the requirements for insurance for their clients, all the way to some very large, as I said, buyouts. We've done over 10,000 diligence projects for our financial clients in my 25 years. And the volume this year is beyond anything I've ever seen. In fact, in our lender team that I just mentioned, we've had our top 3 months of loan closings, and I started that team 20 years ago. So it's been gangbusters, and on the private equity side, the same. I guess the one thing I will point you to, which has been a passion of mine and a lot of fun, is I started a podcast in 2018. Just released episode 85, and I mentioned Jeff Sands was one of my guests who actually joined me at the beginning of the pandemic. He's a turnaround specialist, but have a lot of really great folks that have joined me, and there's no advertising. It's not a for-profit podcast. It's really to highlight some of the key players and active players in the industry, whether they're investment bankers or private equity folks. And unlike today, I actually don't talk that much. I try to ask good questions, let my clients talk, and friends in the business. So you can see that on my LinkedIn if you want to look it up, and you'll probably recognize a lot of folks in there. And I will point you to one other thing about the podcast, which is my favorite. I ask every guest what advice they would give to a young professional or college kid wanting to go into the financial world. And then also, what's your favorite quote and motto? And I put those into montages where you can hear 10 people answer, what's my favorite quote and motto in a row. And those have been great. And actually, I've gotten a lot of emails from college students around the country and even around the world saying that they've been listening and really enjoying listening to that. So that's probably my best takeaway.
I'm checking Jeff's podcast right now.
Sean, if you could summarize and then also let us know, how BKD works with private equity funds.
Yeah, thank you, Mark. Thank you to everyone for joining us today, and then thank you to my fellow speakers for joining us. To summarize at a high level, I always recommend as much as possible doing the work on the front end. Cutting corners is going to result in painful repercussions down the road. It's really not worth it. If you do post-transaction have a dispute, have allegations of fraud, I would recommend that you don't start firing off the nasty emails, making nasty phone calls and threats. You can get somebody like Vince to do that for you. would recommend get together a team, get an attorney, get someone like myself, a certified fraud examiner, to come in and evaluate the claim for you so you can put together a complete package, what's a valid claim versus what isn't a valid claim, and present that as a unified front to the insurance company. Or if you're going to litigation, you're going to need that direction and guidance going through the process. In general, in regards to BKD, obviously I'm a forensic accountant. I do expert witness work, so I provide those services. The firm in general does provide audit and tax services, investment banking, due diligence services. So if you're interested in any of those services, feel free to reach out to me. I believe I'm on LinkedIn and the FING website as well.
Super. Ryan, high-level summary and how you work with private equity.
So I think my takeaway from today is just kind of where I walked in from. There are a lot of tentacles to the reps and warranties that go in different directions, and you have to approach it with a team that can talk about the accounting, the legal, the insurance, and just where all these things go, because they're not reps and warranties impact more than just the four corners of the page where they're written down. And so you have to step back and take a big picture view on how these things are going to play out and how they impact you. From the Entora standpoint, working with private equity, we really focus on the alternative investments, and we've been pretty active in the cryptocurrency, security token, NFT space. And so I think we've been interacting when somebody is going to take one of those to market, whether it's a private company or somebody associated with private equity. That's a lot of where we're dealing with those issues.
Excellent, thank you. And last but not least, Vince, brief summary for us and how you work with PE funds.
Sure, yes. So brief summary, you think of, the legal field a little bit like hospitals, right? You don't always want to go deal with them, but they're there when you need them. And so it's important to, and if you think about the healthcare analogy, it's another great example where preventive healthcare is far better than reactive healthcare, right? It's easier, cheaper to stave something off than it is to try and have to fix it on the back end. And so this is one more example of that. In terms of working with private equity, I work with some funds like Yellowwood Partners in the retail consumer space. Edgewater Funds is more industrial, and then some of the bigger shops like Apollo and Berkshire Hathaway, we work with them as well on insurance issues for different investments that and operating companies they have, and it's always the same. They're trying to safeguard their investment. They're trying to make sure that they do everything they can to conduct themselves in the right way and look after their interests, and they view insurance as a huge part of how they run their businesses. And our job is to help them treat insurance like one more asset in their business, right? And so that's why we try and help clients preserve that, protect it, and maximize the return on those premium dollars that Jeff and his team is just flowing through Lockton at an incredible clip. Well, look, you pay good money for these policies, and when you have a loss arise, you want to make sure that you're able to go and capitalize on that investment. And so we view it that way, and because that's the way our clients view as well.
Super. Thank you to my panelists. Thank you to Bracewell for hosting us. I also thank you to the FANG. I'll give a brief shout out to Gary Solka, who I spoke to briefly yesterday. Folks, if you're seeking a very experienced board chairman for your company who's able to bring billions of dollars to the company because of his relationships, you may want to reach out to Gary. Gary, expect your inbox to blow up. But seriously though, so Gary, if I'll let you just speak briefly, and then we can end on that note. His company's actually just going through a transaction. I'll unmute you. Let's see. Can you unmute yourself, Gary? Joyce, can you unmute Gary and
Or if you could make a speech using just emojis, that would be really impressive.
Well, thanks. Thanks for that introduction. I do a lot of moderating at private equity panels, but I can't get a better introduction than you've given me. So thank you so much for that. It was really informative. You know, I've obviously been through a lot of this. In fact, CAI International, which I've been on the board actually since it went public in May of 2007, is a company that went through a long process. We actually got the offer in May. It took a month and a half to actually document it, and now about 5.5 months. It's going to probably close before the end of the month. But it's one of those that had tons of lawyers, hundreds or maybe thousands, and that's probably why there's all these supply shortages. But you know, it is one of those things that we had 2 strategic reviews. We went through a lot of reps and warranties, although, you know, the people, sometimes it was competitors looking at us, and then we had to do reverse due diligence because it was stock for stock. But we took a cash offer, so it's a little bit easier on a cash offer. And it was about $10 more than we thought due to the, you know, the tremendous amount of container, you know, volume that's coming into the United States, as you can see, in the supply shortage. So yeah, I'll be glad to help anybody or connect with anybody as time permits. You know, this business has been a really fun business. I've had, you know, 30 plus years as CFO or chief restructuring officer. It seems like every time everything goes, as I said before, to hell in a handbasket, people just seem to call on me because I'm willing to kind of do those kinds of jobs. So I'm on LinkedIn, Gary Sock at CAI. I also sent a note, but I'll be glad to talk to, you know, pretty much everybody. This is a great meeting. Thank you so much for organizing.
Super, appreciate it. And then anyone else you have a couple more minutes, so feel free to, you know, unmute yourself if you want to just quickly, if you have a deal or, you know, you're interested in just, you know, bringing to light what it is that you're doing. This is the FANG Financial Executives Networking Group, and so it's not about us just kind of proselytizing to you, not that that's what we were doing, but it's about, you know, deal flow, people connecting. And so I know it can be difficult with COVID and doing things on Zoom. So I want to make sure I give people the opportunity to do that. We have a couple more minutes. If not, we can close the meeting. Jared, do you want to speak up? Jared Steffens, putting you on the spot.
Hey, Mark, thanks a lot. Yeah, I appreciate it. And Gary, thanks for you know, some of the words you just mentioned to the entire group and to the entire panel as well. Appreciate it. Yeah, very informative, Mark. Again, you know, like Jeff, I'm on the insurance brokerage side. I work with Alliant Insurance Services, specialty insurance broker, and of course do quite a bit inside the transactional space, private and public organizations. But yeah, very informative. Great to hear a lot of the different pieces from an attorney perspective, of course, the brokerage side, and of course with all the finance professionals. So just great job, Mark. Appreciate it.
Excellent. Appreciate that. Thanks a lot, Jared. Nikolai, you want to speak up briefly? Nikolai Gogov?
Yes. Can you hear me?
Yes, we can. Yes, sir.
Yes. Thank you, Mark. Thank you for the panelists. It was very informative, very well done. And I learned a lot, actually. As a banker on the ABL side, I do see it in our legal documents and also see it when the deals are done. So it's very important. There's, you know, fraud is everywhere, and unfortunately, and we've had our share of fraud, and we've seen a lot. So we usually have to check everything and make sure that the receivables are there, the inventory is there, but because people get very creative. I remember there was a shrimp deal, and we did a field exam, and the shrimp was there, and then sorry, a couple of days later the shrimp disappeared. So yeah, people are very creative, and you have to check everything. So thank you very much for your time and sharing everything with the group, and thank you, Mark, for putting it together.
Super. Alexander Mozo, do you want to briefly introduce yourself? Technical difficulties, superb. Okay, perfect. Well, thank you, ladies and gentlemen. My name is Mark Hamzat Arabogbo, corporate strategist and business development executive, chairman of private equity of the Financial Executives Networking Group. Kindly look out for our up and coming capital markets talk on the website. And then we also will have a energy and natural resources talk, which will be from the point of view of the corporate venture arm. So we've got Citibank's corporate venture arm, and we also have BP's corporate venture arm. And so we'll be taking a look at energy and natural resources from that perspective. Signing off, Mark Hamzat Arabogbo, Chairman, Private Equity with the FANG. Thank you to my speakers, and thank you once again to Bracewell for hosting. Everyone have a great day.
Thank you all.